Hello, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Monday, the 29th of July. I hope everyone's having a great summer so far. Once again, lots going on in the real estate world. It's tough to keep up, and I got a packed session today regarding real estate news. But first of all, if you are new to our channel, please note that we talk about real estate, the housing bubble, I guess you could say current events related to the housing market, and how it affects buyers, sellers, real estate investors, and really, what's going to happen in the future. So we're trying to figure out the best way to navigate real estate. And I guess you could say my motto is never pay retail. And that's the whole idea. So it's designed to help you make better decisions and just have your money go farther in the real estate world. So if you like that type of information, please do me a favor and subscribe to our channel. You can hit the button on the bottom right of the video here. I'd appreciate that very much. So thank you. And also for, again, people who are reaching out to me, we're always in flux. So certainly talking to people over the weekend and back and forth on email. So let's see if we can continue to connect. So as I always offer, if you'd like to talk about real estate and would like to talk about purchasing, selling, real estate investment, distressed properties, short sales, foreclosures, all those great things that are going on in the industry right now, please drop me a line. The best way to get a hold of me is via email, and I'll be sure to respond to you that way, and we can set up a time to talk. So thank you very much. So again, lots going on today. So today's topics, when we go through it, we're going to talk about subprime 2.0, no credit mortgages, end of the qualified mortgage patch, mortgage fraud, Federal Reserve meetings, lots of mortgage stuff today. Home ownership is declining, Q3 national deal forecast, building to rent, SoCal sales slump, and South Florida foreign sales are crashing. That's the scoop. So off we go today. So news, and I actually missed this last week. There's only so many things you can talk about in the given time that we have, but I actually end up missing this, or I had put it off to the side for a future video and I didn't pick it up. But basically, we call this subprime 2.0. So like we're kind of in housing bubble 2.0, now we're back at subprime 2.0. And the reason why I say that is because mortgages are now available for people who don't have credit scores. So you can be out there in the world and you could be moving along just nicely, but you don't have a credit score. So that's an issue when you're going to get a mortgage. So there's a company called Waterstone Mortgage Corporation. They're a national lender and they lend in 48 different states. And they're now going to offer a lending product for people with absolutely no credit history. So that's very interesting. And they call it the non-traditional credit program, which will use other forms of financial history like bills, rent, utilities, insurance premiums as a method to underwrite the borrower. And if you think about it, the CFPB, which stands for the Consumer Financial Protection Bureau, estimates that about 26 million Americans have no credit score right now, and also states that additional 19 million Americans have a limited or outdated credit history. So this means that 18% of adults are, I guess you could say, credit invisible. So they're not on there. So, and I've dealt with this before too. We've had people who are renters who are trying to obtain a mortgage, and it comes back with respect to there's not enough information. I can't pull credit. They don't exist. Well, why is that the case? Well, people deal in cash. People go to certain locations to cash their paychecks and pay everything via like an Amscot or those type of cash. I cash your check and you can pay all your bills type of store or utility. So people do that, and it helps them navigate their finances. Doesn't mean that they're bad people or they're not credit worthy. They just don't have credit. So that's kind of an issue when responding to a mortgage. So this is the Waterstone Mortgage Corporation. They're going to offer programs to hit this marketplace. So yes, there are those people who need this type of service, but then of course there will be those who really shouldn't be buying a house that don't have credit, that'll probably get qualified as well too. So I guess that's kind of the situation here. So they have debuted this new loan program at a time where I guess you can say a collapse in mortgage rates is failing to bring in more buyers. So it's one more of those things like, well, what else can we do to lower the criteria or lower the standards or open up new programs to hit a larger base that we can sell loan programs to. It just so happens that here we are, even though we're seeing some declines, et cetera, we're still, at the peak of the market as far as I'm concerned. So again, it's one of those things that the concept is, allowing someone with no credit history to purchase a home in an economy that's cycling down towards a possible recession is a recipe for disaster, which I have to agree with as well too. So, but I guess my point though is to all the people who are, I call them naysayers, who and you can look at the videos, you can do searches on YouTube and other medium, and you can see that there's still a fraction or section of people that go, we're not in a housing crisis, we're not in a housing bubble, everything is great, and the reason why we're not going to have one is we have what's called qualified mortgages, all right? And qualified mortgages mean that there's, tighter standards, and therefore we're not going to have these issues that started with the subprime lending crisis back in the last housing crisis. Well, to all those people, here's what I have to say is that, we are bubbling, and look how these things are coming on right now. So back in the last housing crisis, we saw looser mortgage standards up front. Now we're seeing them kind of in the back end of things. So, looser standards helped increase the bubble and have it burst. Well, we're kind of at the peak of the market now, and now we're implementing all these sort of looser standard mortgage programs. For me, as far as I'm concerned, that's not going to help the situation. So what they're doing is they're saying we're going to, make more. We'll make it available to more people who are harder to, prove credit worthiness to buy homes at the peak of the marketplace here. So to me, that doesn't help. It only can lead to future issues going forward. Simple as that. Now, if we want to talk about qualified mortgages, so there's something out there. Again, the CFPB is set to eliminate a regulatory loophole that's, I guess you could say that it allows getting a mortgage easier, more feasible for many people across the country. And if by removing this loophole, it's going to make it more difficult for a lot of people to qualify for a mortgage. So they plan on removing this temporary, they called it a patch, known as the qualified mortgage patch. It's set to expire in January 2021. So you got 2020 and the remainder of 2019 to go get that mortgage. And what that patch or loophole was it allowed Fannie Mae and Freddie Mac to purchase loans from borrowers whose debt-to-income ratio exceeded 43%. So we talked about high DTI. Debt-to-income ratio is the amount of housing expense and compared as a percentage compared to your income that you take home. So that was at 43%, and this patch allowed Fannie and Freddie to raise those levels of DTI to almost 50% and over 50% in some circumstances. So again, short-term patch. Well, clearly, that was exceeded the standards of 43%. So, that was a qualified mortgage, and this is still a qualified mortgage, but, we're loosening standards here and there to allow the debt to income to go over 43%. So back to my point with respect to, I guess you could say the naysayers going, we have qualified mortgages. This is still a qualified mortgage. This was a much riskier qualified mortgage. So when you take a look at this, millions of borrowers have, I guess you could say, relied on the patch to get the mortgages. So a study in March by the Urban Institute found that roughly 3.3 million mortgages, equivalent to 19% of all the loans sold to Fannie and Freddie between 2014 and 2018, were made possible by this regulatory loophole. So that's 3.3 million mortgages that have higher than average DTIs, which to me means that's risk element. That's difficult for people. They're stretching to get into the home. So as rates, as housing values were going higher and things were more unaffordable, they're stretching their means to purchase a home, which to me is another element of risk. So that's the scoop here. So again, so what's going to happen now? So if they're announcing the fact that this regulatory loophole is going to go away, to me, that's just one more item to push you over the edge, saying, hey, better go and buy that home now. Better, go and get that mortgage. So, in the future, this may not be available to you. So you got your chance. This window is here right now. That's only going to stimulate buyers to buy in what's a low buying market right now. But again, using this, qualified mortgage patch, gets you into, more risk as far as I'm concerned, and it just stimulates, the frenzy to buy. So I don't, this is not a great thing. It's helped prop up the industry so far, but now that it's going away, I know, now hear me out here, it may not go away. It's slated to go away in January 2021, but things could change. We don't know that, but right now, people are saying, hey, this is going to go away. So to me, the message is, it's going to go away right now. Jump on the bandwagon, buy a house, buy more, qualify more than you should, take the risk because it could go away in the future. So that's going to try to help stimulate the situation. Despite lower rates, we're not seeing as much buying as people thought. And here we go. We're going to try it again. Which leads me to what I call mortgage fraud. So CoreLogic, every so often, every quarter, they actually produce what's called a mortgage fraud report, National Mortgage Application Fraud Risk Index. And it was actually, I guess you could say that it fell, so the amount of fraud risk fell in the second quarter of 2019 thanks to a decrease in interest rates. So obviously when interest rates decrease, more borrowers come in, so it's easier for them to get mortgage applications through and get approved. Fraud tends to drop, which is interesting. So however, and again, mortgage fraud, there's varying degrees of it. It could be, your classification fraud. Is it your primary, second home, or investment home? So people who are wanting to buy a second or investment home say it's going to be their primary residence. That's an element of mortgage fraud. You misrepresent income on and expenses on your when you fill your mortgage application. That's mortgage fraud. Obviously having identity changes and stuff like that. That's mortgage fraud as well too. But realize it can be minimal to extreme with respect to mortgage fraud. Now, the top 10 metros for the highest risk of mortgage fraud application in Q2, which just happened, are the Miami, Fort Lauderdale, West Palm Beach, Florida areas, number 1. New York, New Jersey, Pennsylvania area, number 2. Looks like McAllen, Edinburgh, Mission, Texas, and Los Angeles, Long Beach, Anaheim, number 4. Deltona, Daytona Beach, Ormond Beach, Florida, number 5. Tampa, St. Pete's, Clearwater, number 6. Albany, Troy area, number 7. Tulsa, Oklahoma, number 8. Orlando, Kissimmee, Sanford, Florida, number 9. And the San Diego area, number 10. So those are your top 10 mortgage locations. Funny enough, I count 1, 2, 3 locations in, 4 locations in Florida. So there you go. So Florida once again is leading the charge with respect to mortgage fraud, which doesn't surprise me. But realize that again, fraud typically goes up with I would call heavily investor concentrated marketplaces tend to have a lot of fraud as well too. So there you go. Speaking of rates, well, of course, the big question is, will the Federal Reserve agree to reduce rates upcoming? So tomorrow, being Tuesday and Wednesday, the Federal Reserve's Federal Open Market Committee, FOMC, is scheduled to have its meetings on monetary policy, and there's a lot of anticipation with respect to economists are predicting that we're going to see a fall in interest rates by at least 25 basis points in September. We'll have to see. So again, what the Fed is stating, the fact that they're going to look at, if they see increased uncertainties in the market, they may react. They also pointed out that softening investments in housing need to be addressed. In addition, housing investment and manufacturing output have declined in the first quarter and appear to have decreased again in the second quarter. So guess what? So that to me indicates that if they see housing slowing down, they're probably going to do something to what they think to stimulate housing, which could very well be a decrease in rates slightly come September, but we'll have to see. Economists are predicting that's going to happen. So there you go. With respect to that, it all kind of flows through everybody. So we've got home ownership back on the decline, okay? So why, basically student loan debt is delaying home ownership for millennials, which is slowing, which is adding to the decline in home ownership rates. Qualified mortgage rules may change, which I just spoke about, which means there's a potential for the decline in home ownership rates. Banks unlikely to extend mortgage credit as time goes on to tougher to give to credit groups and demographic segments. That's going to help with the decline. The comment was a lot of headwinds in real estate. So headwinds, things pushing against us as we go forward. Affordability is number one with the issues, with respect to housing declines. High rental rates affect home ownership. How? Because people are trying to save money who are renting and can't save enough because home ownership rates are down. Student loan debt bringing us all down, and basically sort of going back to the Waterstone mortgage, the non-credit people, large groups of people who are underbanked and underserved with credit. They have no credit or limited credit. These are cash-only people, and they're not in the game where they could actually get loans. Now, according, I said earlier a few minutes ago, according to Waterstone Mortgage, they're going to hit that marketplace. I'm sure if it's successful, we're going to see a lot of other lenders go down that path as well too. But again, we're also seeing declines in certain minority groups with respect to what's happened after the last housing crisis. There hasn't been a big recovery in those home ownership levels as well too. But as a general rule, we're dropping in home ownership. Simple as that. We were at obviously before the last housing crisis, we were at a peak, and we're back down to pretty much lower home ownership rates where we sit today. So there you go on that one. Looking for a real estate deal. Well, here are the markets where you can expect to pay below listing price. There is a iBuyer group called Knock, so knock.com, Knock. They have what's called the National Deal Forecast they put out. So they have an algorithm, a machine learned algorithm, which values customers' homes to current listings in 45 of the country's largest metropolitan areas. The biggest shift they're seeing is a lot of sellers markets are now moving towards a buyer's market over the last couple of quarters. More homes are selling for less than list price. That's the trend they're looking at. Balancing the market when previously the markets were getting ahead of itself. And the top 10 markets with the most current listings predicted to sell below their list price, original list price, is, descending order, Miami, Chicago, Hartford, Houston, New Orleans, Tampa, Pittsburgh, New York, Jacksonville, and St. Louis. So once again, we got Miami, Tampa, and Jacksonville, 3 out of the top 10. That's where you can expect to see more homes selling below the list price. Now, that's a good deal apparently. It still boils down to, if your list price is high to begin with, maybe you're selling it at the right price. I don't know. It's all perception. They say thanks to Amazon HQ2 winner Washington, D.C., Knock is looking at that metro as the most competitive, where buyers will have to pay above listing price. So again, it's shifting. So we see certain areas of the country shifting with respect to what's going on and where values are at, whether they're going up or going down. So that happens now. This is a transitional marketplace. But interesting to know that, again, Miami, Chicago, Hartford, Houston, New Orleans, Tampa, Pittsburgh, New York, and Jacksonville, and St. Louis are the ones where you're going to see the most, I guess you could say, difference between original list price and sale price. Funny enough, when I look at this list here, I see nothing out in the West Coast, even though we know we've seen West Coast prices declining quite a bit and some adjustments there. And I don't know whether that's the fact that, and I haven't looked at whether this Knock doesn't play in that marketplace. So they're talking about what they see, I guess, in their markets. So again, this may be only based on where this iBuyer is currently located. But again, at least they're showing a lot of stuff on our side of the border here, on the Southeast and the Midwest as actually having, potential deals with respect to listing price. All right, this is interesting. Real estate CEO John Burns, he has a consulting company, and he was interviewed last week with CNBC, talked about building to rent. So what's happening now is a lot of the we'll call it REITs and hedge funds, they're trying to buy property. Well, they're not getting their hands on enough property. They've got all this money en masse. So that now they're going to builders, or they're doing projects on their own, and they're actually building communities or buying homes with like brand new to build ready homes to rent out. So as simple as that. You can basically say that, they had an interview with the CEO of, I forget the actual place, but he's building a 250 home subdivision in San Antonio, and they've done the math. They say the 7 to 10 year cash flow models outpaces the money they get on building and buying and selling the house to a home buyer. So why not build it and run that model out and see what happens. That's what they want to do. Now, of course, it's a different capital intensive marketplace. You're getting money, your money to build, and it's paid off quicker as opposed to money to buy and hold. But essentially, they look at this as they've run the models. It's actually better for them to do the 7 to 10 year model, and cash flow better. So believe it or not, obviously rents are up 4.5% year over year. They find that building homes, single family homes, it's more stable than multifamily. So you've got people who are going to be in those homes longer, not the sort of traditional I'm out with multifamily. Obviously it's less volatile than the sales market. Last year 43,000 homes were built to rent. That's the highest it's ever been in the past 40 years. And the CEO of John Burns Consulting, his name is obviously John Burns, he does a lot of analysis on the new home building marketplace. You can find him out there. They have a lot of reports they produce. They're consultants. They consult to a lot of high-end investors, REITs, new home builders, etc. He's basically saying that this market is so hot that they're already talking about when it will be overbuilt and saturated as to what they have to do to work around that or plan for that. So obviously this is what these guys are doing. They're thinking, well, you know what? If I can't buy it, if the inventory is not there for me to buy, then I'm going to build it and they'll come anyway. So there you go. And funny enough, people who are renting these houses are 6-figure plus people, good jobs, etc. They've just chosen not to buy themselves. They'd rather rent. So again, if you can rent a multi or you can rent a nice brand new single family home, what are you going to do? You're going to pop in the home because again, it's brand new. Warranties are there. You don't have to actually don't even have to deal with it yourself. The builder has warranties to the ownership and they're going to fix stuff that breaks and put you got a brand new home. So think about that. Sounds like a good deal for a lot of renters. So there you go. To talk about some values here, just something came out. Obviously, SoCal sales slump. Southern California home sales see the weakest June in 5 years as prices hit an actual sales record. So believe it or not. So high prices are hitting the Southern California housing market hard, reversing the sales gains over the past few months. Sales fell 6.9% in June compared with May, and we're down 8% year over year on an annual basis, obviously according to CoreLogic. And that is the slowest June pace since 2014, where sales gains see an average of 5.8%. So we lost big time there. But again, the median price for all SoCal homes sold in June for a record $541,000, up 1.2% from a year ago. That's the smallest gain since June 2011. So here we are. We're seeing less sales, so less volume of sales, and now we've seen basically the smallest gain in SoCal housing since 2011. So there you go. So again, we're almost at the plateau there where we're going to drop below. So that's something to think about. And my last little bit of news is this here. So foreigners have stopped buying in South Florida. Home sales have crashed 50%. So I talked about this previous video where a lot of foreign buyers have pulled out of the entire U.S. market. Foreign buyers purchased 153 billion homes in 2016. It dropped to 121,000 from 2017, and it dropped to 121 billion for the year ending March 2018, and then plunged to 77.9 billion for the year ending March 2019. So the year over year has seen 150 to 121 to 77.9, $80 billion. All right. Well, in Florida, that's nationally across the board, but in South Florida really is that whole other coast. I'm on the West Coast, so we don't really, we're Southwest Florida. South Florida really is kind of like Boca down. So you got West Palm, Boca, Lauderdale, the Miami area, the whole area down there. So South Florida is a top destination for foreign buyers, accounting for 20% of the international transactions nationwide over the past year. But the Florida transactions involving foreign buyers fell to 36,000 transactions for the year ending March 2019, which was down from 50,000 from the March 2018, which was down from 60,000 in the year in March 2017. So we've seen a chunk, and then a bigger drop now. So essentially, they talk about why that's happening. Well, capital flight from Latin America, has driven a quarter of the Florida real estate market, and that's down. And also, if the U.S. dollar is stronger, that means obviously other currency isn't as strong, which means they're not getting as much bang for their buck. So that's certainly a deterrent. And just the fact that there's been a crackdown on immigration and a crackdown on, I know the U.S. Treasury Department has been very concerned, and a lot of those areas on Florida's East Coast are flagged. So title companies have to report, to the Department of Justice, I believe, or the Department of Treasury, one of those two, any transaction that's done over $1 million in a certain scenario, like if it's purchased by an LLC or things like that. So, the government is looking to sort of, look at money laundering as issues on those large transactions. They want those flagged, they want those investigated. That's that's helping to the lack of sales, the decrease in sales. And also we know, as we said, foreign ownership, foreign buyers, a lot of foreign countries, I don't know what the Chinese buy on this side of the market is as opposed to the West Coast, but there's a lot of countries that have put in fiscal or controlled restraints on money leaving their country for foreign real estate purchases. So a lot of those things are playing into what's going on here. But again, we see it that it's starting to hit, and the numbers are not small numbers. When you're going from 60,000 transactions or transactions to 50,000 to 36,000, that's 10K, and that's a 14K. That's a significant drop in transactions. And again, when you take a look at that neck of the woods, a lot of that is higher buyer or higher value property transactions, which is making a big difference. So again, it's changing. The market's changing. When we see housing bubbles, today we talked about a couple of things. So when foreign buyers and luxury buying drops, that's a sign that the market is oversaturated or the prices are out of control. And now we see the advent of different mortgage programs coming on board, which is another signal that we're trying to bleed and get as many mortgages and many buyers out as possible in a very competitive and overpriced market where people just don't have that kind of cash or aren't willing to jump on those mortgages. So we're stretching the limits of what we can take in as far as buying is concerned. So again, to me, those are telltale signs of what's going to happen in the very near future. So there you go. So that's a lot to talk about today. But again, the big takeaway today is, guess what? Subprime 2.0. So again, the people who don't think we are going to have problems, you might want to revisit what happened back 10 plus years ago and see if you see some similarities, because I certainly do. The ease of credit standards and the almost like takeaway marketing, people talking about, hey, the qualified mortgage patch is going to be taken away from you, better react now, which is trying to stimulate people to buy at the top of the market here. So again, thank you very much for the views, the likes, and the comments. As I always mention, please share this video with your family and friends, help our channel grow. If you're not a subscriber, I'd love it if you would hit the subscribe button and join our little membership fold here. That would be most appreciated. And again, if you would like some information or discussion on the housing market, what to do with your home, what to buy, when to buy, looking at investment opportunities, that where these market niches are and where they are not over or underserved, let me know. I am actively building some new investment products and services right now that I think will help a lot of people get into this game, or at least understand how to never pay retail, or do the best to negotiate, and the tips, tricks, and techniques to keep money in your pocket. That's the whole goal here. So again, thank you very much, and we'll look forward to talking to you again this week.